And welcome back to the last segment of the Investor Coaching TV show. I want to talk about let me get into some frequently asked questions and talk about some basics of investing that I think everybody should know as an investor. This question came in. Basically, the issue was legislation being passed in California, signed Friday by Governor Jerry Brown, establishes a state-run retirement plan. This is what he sent to me. Jim sent me this, and thanks, Jim, for that. For private sector workers who don't have employer-sponsored plans. Now, his issue was, he says, I fear that they can't run this any better than their other departments. So we can see where Jim stands regarding governments and controlling of different departments and different functions. He says, state-run doesn't sound too private. Well, I did some research on the internet to find some articles regarding this idea of a state-run pension plan in California, and I did find this. California creates state-run private retirement plan. Now, what I want you to focus you on was the last line in one of these paragraphs. I'm going to read it to you. It says, he said the program will act as a supplement to Social Security by offering private sector workers a portable savings plan with a guaranteed return. So right off the bat, what I want you to pick up on is there's a problem here. What they're going to do is they're going to take out 3% of the worker's pay, is what they said, and put it into this private plan. Well, you think about it. Social Security, they take out a percentage of your pay and they guarantee you some kind of income in retirement. What's the problem with this? Well, number one, the problem is what they're going to put the money into. Guaranteed. I mean, everybody loves guaranteed. I saw a commercial this morning while I was preparing this TV show, and it was talking about guaranteed, you can't lose money. Well, if you can't lose money, guess what? You can't make money. You can't outpace inflation. Historically, as you've often heard me say, guaranteed investments, rate of return after inflation, basically zero, nothing, nada. So what happens is we go and put our money in these guaranteed accounts, and what happens is inflation eats our lunch, and you don't have anything more than what you put in, versus the stock market where money doubles every 8 to 9 years. If you put up with a little bit of the volatility, the ups and downs, you get paid for putting up with that volatility. Whereas the fixed income investments, not so much. So as far as this program goes, I think I'm with Jim. I don't think it's such a great idea. That was one question. Thanks, Jim, for that question. Another question was this. Stan asked this. It says, hi, Paul. New videos are really great. And if you want to check out my videos, you go to my website, paulwinkler.net, and go to the TV radio tab, and you'll see Investor Coaching. The TV show is there. All the videos are under that section of my website. So new videos are really great, and point out people should be investing and not gambling. Cramer advises. You know, basically what he was talking about, I did a segment on Jim Cramer and something that he was telling people to do a couple of years ago. Got some comments on it as well. You may want to check that out. Here's a question. A lot of people I give your card to tell me that they have all their money in the credit union. Again, what are they doing? All their money in fixed income. They're sitting on the sidelines. Why? Because they're scared. Because they're afraid of losing it in the stock market. They're afraid of losing all their money is basically what he said to me. So what's the issue here? They're worried about losing everything. Well, what has to happen for you to lose everything in the stock market? Well, think about it. If you follow what I teach on this show, which is literally, I own somewhere between 12 and 14,000 companies around the world, all of those companies have to go bankrupt with no residual value. That means their land, their buildings, their equipment, their inventories, all of that stuff is worthless. So you think about that, what's the likelihood of something like that happening? Number one. Number two, if it did happen, guess what? That means there are no profits. If there are no profits, there are no taxes. If there are no taxes, there's no government, there are no credit unions. Realize everything, folks, is built on the stock market. Don't let people scare you into trying to avoid stock market risk and tell you, oh, you could lose everything, because you know, technically the only time people have lost everything is one, when they invest in individual stocks, and number two, when they've bought on leverage. They borrowed money to invest in the stock market and got their loans called. That happened during the Great Depression. So number one, that's one thing I want to point out. He says, so I tell them to study Above the Maddening Crowd, which is my book. and thanks a lot, Stan, for mentioning my book, and then take a tenth of their money and put it in the funds you advise. Now, technically, I advise various asset categories. So he's saying, take a tenth of your money, just stick it in those things that you advise. That way they can learn to manage and follow how well the funds are doing by multiplying times 10. Would that be good advice? Let's head over to the board and talk about whether this is good advice or not. So what Stan's saying is this. He says, literally telling these people, take your money and why don't you just take a tenth of it? Just take 10% of it and invest it in stocks. And then what you can do is you can multiply that by 10 times to see how well you would have done. Well, here's the problem with that advice. You think about it, the stock market doesn't just go straight up. What will happen with these people is, let's say that, typically we look at history, 2/3 of the time the stock market goes up. So 2/3 of the time it goes up, 1/3 of the time it goes down, right? So let's say that these people follow Stan's advice and they go and do this. And they happen to be that 1/3. That 1/3 happens to happen. Then what they're going to do is I knew the stock market was a bad idea, when all along, that's just the way it works. Markets go up and markets go down. There's just no way to avoid that. That's the way things happen. So in essence, what he's doing is telling them to, maybe try this thing out. It's just like trying out stock picking. Let's say you try out stock picking and it works and you do well, you're going to try it more. If it doesn't work, you're not going to try it. And it's going to give you a false reality, and it's going to cause you to do is more of the same, which is on both sides, stock picking is a bad idea. Same thing with something like this. Now, what I'd rather see you do is this. What you want to do is have any amount of money that you might need in the next year, leave that all in cash. Matter of fact, I did a whole video on this regarding time horizon. And if I need my money back at various points in time, now I can start to add stocks to the portfolio. If it's a long time before I need my money back, folks, make sure you're more stock market oriented, because that is the only way, as I said earlier, to protect yourself against inflation. Stock market protects us against inflation. Why? Because inflation is prices going up. Who's raising prices? Companies. What do I own when I own stocks? I own the companies that are raising prices, and I own their buildings, their land, and all of that stuff that goes up in price as well. So, as far as doing something like this, I would avoid this type of a measure. I would avoid putting all of your money in cash, because it is a form of market timing, and we know that study after study shows that when you try to time the market, you end up hurting returns. You do not help returns as an investor. So, point being here, make sure that, read my book, Above the Maddening Crowd. It gives you some great information on investing and how to manage a portfolio properly. And continue to watch this show, because I think you're going to gain valuable insights on how to properly manage your investments. Catch you next week.